Welcome to today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra, and we are going to increase your financial IQ with today's episode where I have Brett DiPasquale, part of the team here at Elliott Wealth Management, not just part of the team, a key part of the team, so that we can discuss the one big, beautiful bill and the headline news about no tax on Social Security, because it's not as good as that headline sounds. Is that a fair way to say it, Brett?
That's a fair way to say it.
So, so no tax on Social Security. Let's talk about what that actually is and what it isn't, so that everybody listening has a better appreciation for what actually is happening, as opposed to what President Trump and politicians will say and what the media will say, which tends not to be accurate at all. So tell us what we need to know.
So the main headline we've seen over the past, let's just call it 6 months to a year, is that part of the big beautiful bill would enact a no tax on Social Security feature. Now, that's not actually the case. That's not saying that the actual bill doesn't give a benefit, because it absolutely does. But we just wanted to clarify what the no tax on Social Security means, how it could impact you, your tax situation, and things that you need to look out for over the next couple years. That way you can really take advantage of this additional deduction being offered.
All right. So
So,
what age does this begin at?
so you can really think of this as the senior deduction, age 65 and over, not calling folks 65 and over actual seniors. Don't want to offend anybody. But yeah, it's age 65 and over. The key elements to this are is you get a pretty decent sized tax deduction of $6,000, $12,000 if you're a couple filing married jointly. So it's not a no tax on Social Security. It is a $6,000 for a single person or $12,000 deduction for a married couple on top of your standard deduction. So it's in addition to, which is a nice value. Um,
Agreed.
yeah, couple key numbers though. So it's not for everybody. The two main numbers are $75,000 of adjusted gross income for a single person over the age of 65, $150,000 of adjusted gross income for married couples. So those are the two limits where the deduction starts phasing out. Um, it will only be in effect as of now from 2025 through 2028. So just a couple years. So really important. But this $6,000 or $12,000 deduction is going to go on top of a married filing jointly standard deduction of $31,500. So additional $12,000 on top of that. So it's definitely a good chunk in overall tax savings.
Yeah. So I like this in the sense that it reduces taxes on married joint filers under $150,000. I would say that that's not the rich. So that's a nice benefit for lower and middle American income earners. Now, some of you out there listening might say that 150,000 income is rich. I don't know, we could debate that, but that seems kind of reasonable. And I like that they're not giving a tax break to someone that's making six, 700, 800, $1 million, because the benefit will phase out as you climb the income ladder. So I kind of like this feature of what was included into one big, beautiful bill, even though the headline news and pronunciations from our politicians, including our presidents, don't do the topic fairly in many ways. But what else do we need to know about Social Security and this one big, beautiful bill that was passed into law?
Yeah, I think one thing to look out for or just be aware of as you're going through doing your planning, your tax planning, your financial planning for the year is, I mean, at Elliott Wealth, we do a lot of Roth conversions for clients because Oftentimes, they're extremely beneficial. But taking a look at this deduction, you really want to be cognizant of when you're doing your Roth conversions and for how much. So you don't want to necessarily be pushed over into the phase out portion of this, where you're, instead of getting your full deduction, you're being penalized because your income's too high based off of Roth deductions, based off of IRA withdrawals. So it's just something to take into consideration as you're going through doing your financial and tax planning for the year.
Yeah, I think for listeners and the work we do here for our clients to try and help them win with money, make good financial decisions, build wealth, maintain that wealth through their retirement years, is that something like this, although relatively small in the whole scheme of things, does open some creative but valuable strategies in some instances where we could reduce taxes, maximize money that's passed on to the next generation. And so we like wrinkles like this because it does allow us to do our thing, if you will, to help our clients. As we wrap up, Brett, I think there was one forecast, just so you could appreciate, listeners, what this actually means. Currently, about 64% of Social Security beneficiaries, people receiving money from Social Security, pay zero taxes. And the estimate is that that'll go from 64% to 88%. So that means that more Social Security beneficiaries will not pay taxes on their Social Security benefits. I like that, especially because, as we already discussed, the 64 to 88% doesn't include the wealthy and the very rich amongst us. So that seems pretty good. Is that a good summary, Brett?
Yeah, it does. Absolutely. And
So,
the one, yeah, go ahead.
no, you go first.
No, I was just going to say that my last thought on this is, as you're going through doing your taxes in the early part of 2026, whether you use a software, whether you use a CPA, just make sure, just keep this in the back of your mind. Make sure you get your deduction, and make sure you're planning correctly and efficiently to get as much back from the government as you possibly can.
I like it. Brett, thanks as always for joining me today. This is good information. Everyone, I'll be back with you. We will be back with you on the next episode of the Simply Financial Podcast very soon. Check out our website, www.elliottwealth.com, for more information about Brett, me, the team, the work we do. Sign up for a complimentary consultation. So thanks for listening. And again, we'll be back with you very soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.